Hi there, Brock VandenBerg with TaliMar Financial and TaliMar Income Fund. Today, we're going to do an overview of the February numbers. I got some exciting information to share with you. Also talk to you about what we're seeing in the marketplace. So let's go ahead and hit the numbers. All right, so let's go ahead and get started. There's a lot of interesting information that we're going to cover. We're going to talk first about February returns for the investors. Probably aware that we returned a little over 9.7% this month or in February to the investors. Obviously, that's showing how much demand there is for our capital and what we can charge for the capital. We're also going to talk about how the recent bank closures of Silicon Valley Bank and Signature Bank affects us as a lender. And then third, what we should expect here going through March and early portion of this year. So let's talk about the notable successes. Number one, the net return to the investor was 9.72% in February. I do want to just somewhat note, though, that the way the returns are calculated, it's actually on a daily rate. And so because February only had 28 days, you can't really do a direct comparison with January, where we had about an 8.8% return. I would say that if you were to compare the two, February returns were going to be around that, a little over 9%. But it does demonstrate what kind of returns we can yield here in the mortgage fund. Number two, no late payments or loan defaults. Portfolio is super clean. Borrowers are making their payments on time, and we're confident about the loans, obviously, in the portfolio. We raised just shy of $2 million in February, which is about on track with what we're raising per month. There is a ton of demand. We are getting a lot of calls for new loan or to fund new loans. I would say that the only thing that's holding us back is really that we don't have the amount of investor capital in the fund that we would need to fund all the loans that were coming in. And then we returned roughly $243,000 to investors last month. That's an all-time high. And we're just excited about the returns that we're bringing to investors. So let's talk about loan origination. We funded 4 loans in February, totaling just shy of about $5 million. Our goal typically is about $5 to $7 million based upon the amount of investor capital that we have available. The average note rate was 10.3%. That was the highest note rate that we've had since launching the mortgage fund. And again, it just shows you what borrowers are willing to pay for private lending capital and the opportunity out there. Average loan to value of the loans that we funded, the 4 loans, was 61%. Obviously, we're trying to keep our loan volume between that 60 to 65% LTV. Average duration, 12 months. Super important to keep loans short term. We don't want to take interest rate risk, nor do we want to take market rate risk. Try to keep that loan duration as short as possible. And again, we're focused on funding first trust deeds. So let's give you an idea of kind of what our historical averages on loan volume were. As you can tell, they're everywhere. This is something I always talk about. This is right at the end of the year when rates started to really creep up. We saw loan volume drop, and the amount of activity happening in the market had dropped. But as soon as about November hit, loan volume came in strong, and this is what you're seeing right here. These numbers would be significantly higher, but we're held back by the amount of capital that we have available to lend. So we're just picking and choosing the right loans to be involved with based upon the available capital that we have. Types of loans that we're funding, again, a good 50-50 mix between fix and flip and bridge loans. Again, fix and flip loans are loans simply where the borrower is purchasing the property and they're going to rehab it and sell it at a future date. I had anticipated, I said this last month, that these types of loans would have disappeared about this time. However, the housing market here in San Diego is red hot. And I know it sounds odd. I know the media is telling you, well, housing prices are down and the number of listings are down and transaction volume is down. That's partially right. Transaction volume is down. Listings are down. That's just because nobody's listing their house for sale. So what we're seeing a lot of, however, are the homes that are coming to the market are selling. Now, they may not be selling at what the April highs were, but they are selling. So bridge loans are just simply based upon current value of the asset that they're the property that they're purchasing or refinancing. There's no real value add component to it. Usually the exit strategy on a bridge loan is a refinance into more conventional financing. Borrowers are using bridge loans simply to quickly close on a property. Maybe there's something where they can't refinance the property. Thing that we're seeing a lot of right now are banks are on matured loans are not extending those loans. They're looking to add liquidity to their balance sheet, and by doing so, they're doing fewer loans. I'll get into how that affects us. And those that are maturing, they're having the borrower pay it off. So a lot of those loans are falling into our lap. Loan servicing. In the portfolio, we have roughly 48 loans, totaling just shy of 40 million. So that's going to be an all-time high for us. Average loan size is around 826,000, a little higher, but 826,000. Why is that important? That's because it's really pushing us out of what I call competitive range of your trusted investor. Really hard to aggregate anything above 1 million if you're a trusted investor. Obviously, people don't have that type of money just laying around. Tough to aggregate enough trusted investors to do loans greater than 1 million. So as soon as you kind of get over that 1 million mark, the amount of competition significantly declines, and you can get a little higher of a return and most likely get a little lower of a loan to value ratio on the loan. So our goal is really to be in that kind of 1 million to maybe 3 million window for our fund. Average loan to value ratio right now, the fund is a little over 65% at 66.1%. Our target is that 65% LTV ratio. Weighted average coupon, so this is the gross return that the fund is receiving on the portfolio of loans, is about 8.85%. That'll continue to creep up as some legacy loans that are lower yielding pay off or they're extended, and after they're at the time of extension, we are increasing the rates on that loan. Interest income as of today, we're just shy of 300,000. This is exciting. Again, all-time high for the mortgage fund. Reason why that interest income is increasing. Number one, obviously we're bringing more capital in as that fund grows. There's more interest income that is paid out. And then second, that the interest rates that we're charging on our loan portfolio have increased significantly. So average term of the loans are about 14 months. Again, we're trying to keep them at 12 months or below, or if at least they go beyond 12 months, there is an option that we readjust the rate on that loan at the 12-month mark to what the market rate for hard money is. If you're investing in trust deeds, definitely stick under 12 months or less. You don't want to take that interest rate risk. Loans in default, we have no loans in default. And so, as I mentioned earlier, their portfolio is super clean. Let's talk about a success story. So I always like to post these success stories. We do a lot of fix and flip loans. These are where borrowers are buying these properties. They are rehabbing them and then listing them back on the market. Why are these loans so important? Number one, they're great loans. Borrower wants to add value to the property. There's a clear exit strategy. Borrower is going to sell the property. And it's just incredible what they do to the properties. In this case, this loan was in Escondido, California. Loan size was $456,000. It was a fix and flip loan, first trust deeds, and the rate that we charged the borrower was 8.75%. Now it's funny, I see 8.75%. That was rates that we were charging about June timeframe of last year. You've seen the significant movement, obviously, in what we are now charging today. But let's go ahead and take a look at the video. Before we start the video here, I do want to note our team underwrote the finished value of this property at $652,000. Now, again, this was around the June timeframe. Okay, this is right as things started to slow down. The Fed was increasing rates. Media is telling us at about I'd say maybe July, August timeframe that the housing market is collapsing, that somehow we're going to go into some big recession. But when they finally sold it, and this was sold in February, The borrower actually sold the property for $664,000, so actually greater than what we had underwritten the final price for. But all within we were able to estimate the value within a 2% difference. So the team is very good at estimated finished values on these properties. We've been doing it since 2008. We funded over 700 of these types of loans. So they make great loans, again, because they're short term, borrowers adding value, and there's a clear exit strategy. So let's take a look at the before and after video. All right, so again, demonstrates what these borrowers are doing to the property. It's exciting, and we're constantly marketing for these kinds of loans. Okay, so let's look at the loan portfolio. Currently, the loan portfolio, we have a little over 60% in bridge loans. Again, these loans are where there's no value add. They're short term, usually 18 months or less. We have about 24,250,000 in these types of loans. The remaining loan portfolio is about 30% fix and flip, and about 8.5% on fix and hold. Fix and hold are the same idea and concept as fix and flip loans, but their exit is they're going to refinance the property and hold it as a long-term rental. This type of loan, the fix and hold loan, very popular in 2022 when rates started to creep up. Market had slowed down, but now it's a little more difficult because the cost of capital, the cost of that long-term 30-year rental loan has gone up drastically. And so it's tough to make those types of rental property loans pencil in markets like San Diego, Orange County, LA, where there's such a discrepancy between what the income would actually, or what a property would generate an income and what the actual value of that property is. It makes a lot more sense in markets like Arizona, Texas, Florida, some of the southern states where that income is much more correlated or close to the actual sale price of the property. So loan portfolio by property type, we're overwhelmingly SFR 1 to 4. That's the property type I like lending in. Again, it's the most liquid type of property that you can lend on, and obviously transaction volume is higher in this property type versus what you may see in commercial or industrial. That being the case, the limitations on SFR lending is that the loan sizes tend to be smaller. So you have to be willing to go into some larger loan sizes, therefore, or to make sure that there's money that you are funding loans that are big enough to make sure that you've got all the capital out in loans. And so you do target commercial and industrial properties as well. I really like the industrial property type. There's, again, huge demand here in San Diego and a lot of urban markets for industrial space, especially areas where they're reducing industrial space to make way for more residential properties. Mortgage funds. So right now, as of actually February, we had a total of $32.5 million in investor capital. The net interest income in February was $243,000. Again, I had mentioned that we're almost breaking $300,000 now in estimate investor payouts for March. Yield for February was 9.72%. That just blew away our estimate for the year for 2023. We were estimated a average return to the investor of about 8.5%. We're going to blow right through that. We're going to be closer to 9%, if not higher. Year to date return for the investors, so that's January and February, is at 9.25%. And the 12-month trailing average is little over 8%. Now, again, look at the 12-month trailing average, compare that with what we returned in February and what we returned year to date. We'll see this number increase substantially as we see past months fall off, and we replace them with more current months. So let's look at what we've got in the fund today. So we've got a little over 35 million committed into the fund right now, with another, I'd say about 2.25 million of investor capital that is going through the pledging process. So either the investor is going through the accreditation process, or we've got the subscription agreement out to the investor, or we're waiting for those funds to be deposited. Currently, we have 149 investors in the fund. We'll be breaking 150 this week. It's exciting how much interest we've been able to get simply over the last quarter in the fund. Investor returns over the last 12 months. So if you looked at February 2022, we were sub 8%. I think we're about 7.75% right there. February of 2023, in just 12 months, we're at 9.72%. And we're going to see a steady increase in investor returns going through the first half of this year. So as many of you know, about 2020 is when we made that transition over to, late 2020, early 2021, we made that transition to the mortgage fund. Primary reason we made that change to the mortgage fund was that it offered a much more diversified approach for our trust deed investors. For those that are not familiar with trust deeds, simply imagine investing in individual loans. So you invest in an individual loan versus the mortgage fund, which is a diversified portfolio of loans. Number one, the mortgage fund provided more diversity. Number two, a more consistent investment approach. One of the hurdles with investing in individual mortgages is that, well, number one, if a mortgage pays off, you're constantly looking to place your money in the next trust deed. And if you can't find a new trust deed, well, that money's just sitting in your account, not earning interest. Number two, it's always tough to find a trust deed that matches, or the investment amount matches what you have available to invest in. And so for many investors who are just getting tired of jumping between trust deeds, the mortgage fund made more sense. Third reason, the tax advantages. And that's so important to talk about right now, especially as we're going through tax season, is that the mortgage fund, because it's structured as a real estate investment trust, qualifies or makes you eligible as an investor for the 20% qualified business income tax deduction. Essentially, what you get a 20% tax deduction on the income that you earn, no matter what your income level is, and no matter how you're invested in the fund, except for if you're using retirement funds. Obviously, retirement funds don't qualify for that 20% tax deduction. If you ever have any questions about the tax deduction, because I know it can get complicated, feel free to reach out to me. I'd be more than happy to talk to you about it. And then the fourth reason is the ability to reinvest distribution. So if you have a trust deed, you can get paid out every month. Those funds sit in your account. They don't earn any interest until you reinvest those in a new trust deed, or you aggregate enough and then at some point in the future use that to invest in a new trust deed. In the mortgage fund, you can immediately reinvest. The very next month, you earn compounded interest. So that's the fourth real advantage of it. So let's talk about the market update. Obviously, last 2 weeks, everybody's talking about bank failures, and how does that affect our fund? So I want to first off say Endeavor Bank is our bank. I did speak with my representative at the bank, and he assured me and demonstrated to me that their liquidity is just fine. I think what you saw with Silicon Valley Bank was kind of an anomaly, just simply because of who the Silicon Valley Bank was banking, being that they were VC firms, tech firms, They had a lot of, again, liquidity on their balance sheet, but they were taking that money and investing it in medium-term debt instruments that had a fixed rate. So, as investor capital flow deposits were coming out, unfortunately, they were stuck holding these medium-term investments that didn't hold the value that they had when they originally purchased them. And so once that occurred, they had to take some significant losses. Depositors heard about that, started pulling their money out, and it just created a run on the bank. And so that's why the FDIC had to take over. What I felt was super interesting was that the government did step in and guarantee all the deposits. So obviously you're aware that if you deposit your funds in a bank, they're guaranteed up to $250,000. There was some big money deposited at this at Silicon Valley Bank, and I think in an effort to stop any type of contagion into other banks, the government immediately stepped in and saved the bank. Now, are they going to do this for other banks? I don't think so. I don't think you're going to see this issue in a lot of other banks, but time will tell. The other thing that we're seeing is significant volatility in the S&P 500. So if you're invested in the market, in the stock market, you're seeing every day volatility. A new news story is coming out, and either you're seeing a huge sell-off or huge gains in the marketplace. And we're seeing a lot of inflow of capital from people that are just, tired of that volatility, and they want to see just a consistent monthly return. And being that we returned 9.72% in February, I think it's very attractive when you compare that return to long-term stock market returns. So we're seeing a lot of inflow of capital coming in from people that are pulling money out of the out of the general market. Unemployment lynched lower at 3.5%. I don't have the updated numbers for February, but I can tell you unemployment hasn't gone anywhere. Again, this is a news story. This is the media telling you that we're having some huge layoffs at all these tech firms. The tech firms hired the percentage of people they're laying off to what they have hired in the last 2 years is infinitesimal. I mean, it's a rounding error for them. So obviously, if you've been impacted by the layoffs, it's terrible. But I don't think you're going to see unemployment. A significant jump in unemployment here in the next quarter. I say quarter because obviously I don't know what's going to happen, come mid to later half of the year. If rates continue to go up and it does impact businesses, you're going to see some unemployment. Secondarily, the Fed needs to have unemployment. In order to stop inflation, you need to get money out of the system. And one of the ways of doing that is putting more people on the unemployment line. So fourth, national average interest rates right around 6.5%. This is again bumping around. We saw rates actually drop at when the announcement of Silicon Valley Bank failure. You've seen kind of rates creep back up. So you're around 6.5%. U.S. inflation's around 6% according to the U.S. Labor Department. I know for a lot of investors, they don't believe that inflation rate, but I look at what what I'm paying for at the gas pump seems to have stabilized. What I'm paying for at the grocery store, albeit it is still expensive, seems to have stabilized. So I'm seeing that inflation rate come under control. I anticipate another 0.25% increase on the Fed rate come late March. I think it's a harder one to predict, especially with what happened in the banking system. However, the inflation rate is the number one thing that the Fed is looking at. And until we see a considerable drop in inflation, I think they're forced their hand to continue to raise rates. Good thing for us, obviously, as a fund, that simply means that we can raise the rates of what we're charging our borrowers. San Diego home prices. I want you to take a very close look at these numbers. I took this off the San Diego Realtor Association numbers. If you were to look at days on market, this is the number that I really look at. And if you were to look at February of 2022, days on market were 34 days, okay, which I thought was actually kind of high because February 2022 is when we started to really see a significant increase the amount of sales and what sales we're going for. We're at 46 days. That's for a month and a half of inventory. That's near zero in San Diego. So we're not seeing this significant increase. In fact, we actually saw a drop from January. So homes are moving in San Diego again. And I think if after talking to a lot of my investors who are listing houses after they've rehabbed them, they're getting asking price and they're getting multiple offers. So I'm confident, I'm bullish. But I do want to kind of asterisk this is that a lot of people panic in those kind of markets or when they hear this news. And I want to be super clear is when you're investing in a mortgage fund, investing in trustees, you can't panic. You have to look at the fundamentals of the market that you're investing in. You know, we're focused on San Diego. I guarantee you they're never going to overbuild San Diego on housing. We can't build housing in San Diego. We got too many NIMBYs, people that are fighting the housing market. It is too costly on permitting houses. And you know, when you take all those factors, I think we're well insulated from any huge market swings. Also, the other bullet point I want to show you is that the average sales price. Now, again, this is, you know, I'm interested to really dig into these numbers, but this is what I pulled from the, again, San Diego Realtor Association. The average sales price had actually increased from February of last year to February of this year. Now, this is where home values really started to jump. They peaked in April. This is where they were jumping about 30%, I think 25% in San Diego. They've come down drastically from that April peak, but these are what the numbers are showing us on what's sold in February. So discussion points. We talked about the recent closing of Silicon Valley Bank and Signature Bank. Again, our partnership is with Endeavor Bank. We're confident in the relationship we have there and the strength of their balance sheet. And I'll tell you, we don't really hold a lot of cash either. So, you know, it's not that, you know, I would say that we have less than 2.5% of total investor capital held in cash. So it's not like we have a huge exposure to a situation where if a bank did fail, that we'd have a considerable cash on their balance sheet. It also, number 2 point, it demonstrates the volatility in the capital markets. And we see this every day when we have loans called in. And, you know, I always question, you know, I look at the borrower strength in terms of their credit rating, of their cash flow, the property that they earn, and loan to value ratios. And, you know, I'm getting these loans that are so bankable. So and I always question the broker, the borrower, hey, why aren't you just going to a traditional bank for this kind of loan? And every time they say, you know what, the banks are not lending. This is our only option. And so I'm seeing a lot more of that. And that, again, goes back to the volatility in capital markets. There isn't a lot of capital available to borrowers that own real estate investment properties. And this has just really opened up more opportunity for more loan volume for us. I've probably seen a 100 to 200% increase in the deal volume that's coming through to us. So it just demonstrates the opportunity out there. We have plenty of room for new investor capital to come in. We can get it to work immediately. A lack of available capital, bullet point 2 here. Lack of available capital is driving up returns for private money loans. As I had mentioned before, it just demonstrates the volatility in capital markets. And the San Diego housing market is a seller's market. You know, maybe end of last year, you kind of had a buyer's market, but any investor will tell you, an agent will tell you, they are getting multiple offers for their properties. So again, I'm bullish long-term that San Diego housing market is going to be just fine. So this is event season. February was very busy. This was the California Mortgage Association, CMA. It's one of the largest associations dedicated to private lenders for the state of California. It's really an educational seminar, bringing a lot of vendors and attorneys, accountants, and whatnot to talk about new rules, regulations that are occurring in the state of California that we should consider when lending. So we get speakers in from both on the residential and commercial side, and really an opportunity to share ideas. And so you see image on the right is actually a round table. And I thought this was a really cool portion of the event is they had about 9 round tables. Each table had a different subject that they had a subject matter expert talk about. So, one subject matter may be loan servicing. So what are best practices for loan servicing? Another table maybe have an attorney talk about closing. So what type of property lender policies should we be getting? How should we interact with escrow? I think the other one was about bankruptcy. So what should we best practices with borrowers that go into bankruptcy? So there's a bunch of different subjects. You get to sit down, you get to ask the expert, and you really get to take away a lot of good content from the event. So we got two upcoming events. Gerasi in mid-April. Gerasi is our attorney firm that drafted all the fund documents, and they continue to act as our attorney for the mortgage fund. I'll actually be representing TaliMar Financial on a panel talking about, I think the panel is about the growth of mortgage funds in the industry. And then we've also got the National Lending Association NLA conference in late June. And that conference is more of a kind of a networking event with mortgage brokers come in, and lenders can talk to mortgage brokers about what programs we have to offer, and just to create that network of brokers that can bring us loans. So common questions I'm getting. Number one, everyone should have access to their K1s on the VeriVest portal. If you don't have access or you're having trouble logging into the VeriVest portal, let us know and we'll get that K1 over to you. 1099s have already been sent out by FCI Lender Services. If you did not receive your 1099, contact FCI Lender Services and they'll be able to provide that to you immediately. Number three, retirement funds can be invested in the mortgage fund. I think a lot of people don't understand that they can take funds in their 401k or their IRA and invest in the mortgage fund. You can do that through a self-directed IRA custodian. We're working on getting on the Charles Schwab platform. That'll probably happen in about 6 months. So you actually be able to use your Charles Schwab and I think TD Ameritrade accounts to actually invest in our mortgage fund. If you're interested in learning about how you can do that, please contact me and I'll let you know kind of what the process of investing in the fund through your Schwab account would be. 4, we have no income cap to qualify, or there's no income cap to qualify for the 20% tax deduction. I talked about this earlier. When you invest in the fund, you're qualified for that 20%, what we call qualified business income tax deduction. A lot of investors, especially high net worth investors, have income greater than what that QBI tax deduction allows for. But because we're structured as a REIT, a real estate investment trust, that income cap is waived. So you're going to receive that 20% tax deduction no matter what, as long as it's non-retirement funds. If you want to reinvest, so if you want to put more money into the fund, the minimum investment is $1,000. Feel free to reach out to us if you want to put additional funds into the mortgage fund. It's a much easier process reinvesting funds than it is just getting an account set up. Usually takes about 48 hours. Again, there's no lockup period for investments. We have waived the lockup period. So if you don't like the investment, you want to get out immediately, we can return your funds. We are extremely liquid right now. So we have a lot of loans coming in and out of the portfolio. We have a lot of investor capital coming in. So it's a liquid investment at the moment. Promotions. We continue to offer that $1,000 credit if you invest $100,000 or greater in March. So you'll receive $1,000 if you invest $100,000 or greater in March. That is open to new and existing investors. Your pledge has to be submitted by March 31st. So no, you can't do it April 15th and say, well, I missed out on March 31st. It has to be before March 31st. If you're opening up a new account, I know it can take some time. We just have to receive that pledge by March 31st. Today, so since we've been launching these credits, we've paid out over $41,000 to investors since 2022. It's a lot of money. So take advantage of that credit, get your money in. Love to have you involved in the mortgage fund. If you refer an investor and they open up account, they don't have to invest. They just open up a new investor account with us. We do offer a $250 gift card. I send out that via an Amazon gift card. So please refer anyone. We have plenty of room for investors in the fund. So that does it for March update. I'm extremely excited about the returns for February. I'm even more excited about the opportunity that March is presenting to us. I'm confident that we're going to continue to push that 9% 12-month average return to the investor. Our mortgage fund, the fund in general, is performing well. The health of the fund as well. We got no late payments and no defaults. So if you're interested in learning more about investing in the fund or re-upping, feel free to reach out to me or go onto our lender portal and submit your request. I want to say thank you for listening to our webinar, our update here. And yeah, we'll meet back up in mid-April and we'll give you even better information. Thanks very much.